Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, in this episode, I want to get into, a little bit of more of an analysis of market volatility drivers a little bit, but also how this, if you will, compares to what we've experienced in the past. And, obviously, I think at this point, what we're all watching for would be the uncertainty to fade a little bit, right? As we learn more about the administration's trade efforts and better understand how the changes in government are going to be affected as we move forward. All of that has been really uncertain with a little bit of choppiness in terms of how things have been communicated and back and forth on policy. But we're sort of setting up for an environment of in my view, where we're going to see the uncertainty fade. In any event, let's kind of get into it in terms of the environment and volatility. I guess the first thing I want to mention is this concept of a behavioral bias called loss aversion. And the idea with this is pretty simple. I think we all experience it, and that is that we feel pretty good about gains, but we feel even more negatively about losses. So whether that's, let's say you're at a casino and you win or lose, or in this case, of course, I'm talking investing in the markets and feeling, pretty good about things going up, but feeling even more intense emotion, if you will, as things go down. And so for most folks, when we have these periods of market weakness, it can be kind of emotional. But, as a result, what we look to do is sort of find and understand the data to kind of anchor us a little bit and have us feel less emotional, if you will. And so let's start with one concept that I often go to, which is if I were to ask an individual, well, how are you feeling with your investments back, let's say, middle of 2024, so not that long ago. And you kind of said, let's put ourselves back in time and see how we were feeling about the markets and about the level of our portfolios. Generally speaking, people would say, hey, that was a pretty good time. The markets were moving higher. And when they think back at that period, they'd say, oh, I felt pretty good. Now, the reason I mentioned that specific time period, and it's sort of May and June, as the market has bounced around, and I'm specifically focused on the S&P 500, that index actually hit its record in May of June or last year. And so depending on what level you're looking at. And so it happens to be, as I record this, when we look at where things were just yesterday, it was basically, I think, the third week of June, roughly, that the market hit its record that was at the level it was trading at yesterday. And so, all that to say, I don't want to over-focus on that, but it's sort of a recognition that, hey, we've seen markets go up since then come back down since then, but the level of decline isn't that severe in the historical context, and it's not that erosive, if you will, in terms of wealth, despite how it all gets covered. And again, it's people sort of focus in on the downside rather than the upside here. As it relates to history, so a few other statistics which we've seen and we're kind of working on. If you go back to 1954 all the way through 2024 and just look at the pattern, in this case, again, the S&P 500, declines of 5% or more. So that level happened about twice a year on average over that time period. So those kinds of declines happen all the time in a way. When we look at a 10% decline, which is called a market correction, on average over that period, it happened about every year and a half, right? So these, and that's, we're not even there now year to date. But thinking, let's say we're in that neighborhood roughly. So this experience, which is really dramatized and people feel bad about, it's sort of every a couple of year event, to be generous. Now, when we look at 15% or more declines, that happens about every 3 years. And then the 20% decline, which people call a bear market, that on average has happened every 6 years. And so even that, we don't want that to happen and be sustained. But, at the end of the day, it's sort of like, well, it's not that uncommon relative to what one should expect as a long-term investor. Now, again, as we look at the market year to date, in round numbers, it's down about 8% based on the S&P 500. And I think I may have mentioned this in the last episode, but just to revisit it, when we think of capital market assumptions, which are forward-looking estimates for the market, we estimate both an expected return, which for large cap stocks is just shy of 8% positive. And then we actually also model out a variability of return, standard deviation of return. And, it's all sort of a statistical thing. But punchline is when you put those parameters in and look at the chances of a return of negative 8% or worse, that is expected analytically to happen about every 6 years. So again, as a long-term investor where you're going to invest over periods that include these 6-year intervals, it should be unsurprising. So it shouldn't be surprising that we have these experiences from time to time. Now, another thing that we've taken a look at is, sort of the patterns year to year. So we have one exhibit that you can go to stiefelinsights.com and check out. But basically, or in this article that we've written on this topic, essentially what you're going to find is this exhibit that shows calendar year returns. In this case, we go back to 2000, where, not all, but a good majority are positive. And yet when we look within each year, every single year has a peak to valley negative return, sometimes quite dramatic. And sometimes when those are dramatic, the year ends up being positive. So it's sort of like just reminding ourselves, here we are in April of 2025. It's a negative year so far year to date. Who knows where we're headed? We're going to kind of keep an eye on things in that regard. But this isn't that unusual in terms of experience. But back to that bias of loss aversion, it feels worse than it felt when things were going up, and just the magnitude, sort of the intensity of the emotion. Now, of course, what we're watching for, as I said at the beginning, is for some uncertainty to fade around policy and DC policy transitions, including and especially trade issues, tariffs, and negotiations, right? And so one thing that's been supportive of the markets recently is the administration coming out and saying, hey, we're knocking it out in terms of essentially negotiating with folks, and so we're going to keep an eye on that and further analyze it. But that's the tension point where people think, hey, if tariffs stay in place too long or forever, then we've got a weaker economy. And yet, if we see a clarity and a move towards a free trade kind of set of arrangements, that could be very positive for the environment. So that's sort of one of the levers that we're keeping a close eye on. In any event, that's what we wanted to get into in this episode. Thank you so much for listening, and we'll catch you on the next one.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.